So another thing that I want to talk to you guys about today is um, okay, options, right? So a lot of people trade options, and a lot of jockeys out there who keep just swinging options. In the days of meme stocks, you guys remember those? GameStop, AMC, Bed Bath and Beyond, and many, many, many more. And what happened? They bankrupted a ton of hedge funds. Why? Because of this right here, options. So what are options? I do trade options a lot. Okay. But again, I'm going to go simple basics today. Oh, I see my partner here.
What's up?
Hello. How are you, sir? How's
Oh,
your work?
fantastic. What's up?
Um, okay, I will answer those questions. I just hold your horses for a second. So options is a derivative. Derivative meaning is derived from the underlying equity or index or commodity, because there is options all over the place these days. Yeah, I will talk Tesla going trend lines today, Jared. Understanding stock options. Again, I will recommend 3 books at the end of this segment. Start educating. But options are a type of financial instrument known as a derivative. As I said, this means their worth is based on or derived from the value of the underlying security or the asset. In the case of stock options, which a lot of people trade these days, stock options has exploded with 2020. But during the pandemic, everybody was getting government money. Everybody was in the stock market. Options were being swung by the millions, millions, millions every day. Contracts, by the way. The option is a contract that creates an agreement between 2 parties, a buyer and a seller. In every transaction, by the way, stock, equity, futures, commodities, there's always 2 sides of the party, right? A buyer and a seller. It has to be. And just like a real estate transaction, a buyer and a seller, or a car dealership, right? There's a buyer and a seller. There are 2 types of options. One is a call option. The other one is called a put option. I'm not going to get into, just like with technical analysis, I talked to you guys about, support, resistance, breakout, breakdown. I'm going to keep it simple today. There is million ways to trade options, risky ways, less risky ways, whatever they are. You guys will figure that out. 2 types of options. There's one is called a call option. One is called a put option. Now, those are given. Those don't change. There is some other keywords that you have to understand when it comes to options. One is going to be called a strike price, like a baseball strike price. Another one is going to be expiration date, right? So those 4, you have to get it in your head. Just call, put, strike, and expiration, okay? Call options are options that give the right to the buyer of the call option to purchase the underlying asset at a certain time at a certain price. So certain time is called expiration. Certain price is the strike price of that option. Now, if I can, put a, analogy in front of you guys, let's say I know that there's going to be a freeway built next to a piece of land. Okay, call it inside information. We don't trade on inside information, but call it inside information. So that piece of land that exists, I want to buy, obviously, because what's going to happen to the price of the piece of land? Okay, it's going to go up once the news comes out, right? That the freeway is going to be built or a mall is going to be built, and then once the freeway is built, then houses are going to be built, right? That land is going to be very valuable. Well, with an option, I don't want to spend and go buy the whole asset all at once. I want to give myself some time in case government maybe changes their mind and they don't build a freeway there, right? So I want to limit my risk. So options are a good way of trading things with limited risk and unlimited upside or downside potential. Okay. So let's say in that piece of land analogy, I go to the owner of the land. I go, look, I want to buy an option. I'm going to give you upfront money. I'm going to give you $1,000 today, but you have the obligation to sell me that piece of land in 6 months at a certain price, because this call option that I'm buying on this piece of land is our contract. You must adhere to that contract. Okay. So let's say 3 months goes by, it's announced that a freeway is going to be built. Well, what happens? I have the option to buy from the owner that piece of land at a certain time at a certain price. Now, I can wait until that day and buy it. Now, then I have to put up more money, obviously. But what did I do? I didn't tie up my equity or capital, all of it, the first day. I gave myself a chance with limited downside. If the government had said, okay, no freeways being built, well, the money that I put up, little amount of money that I put up, the $1,000 to buy that piece of land, would go bye-bye. But what did I do? Is it better to buy the whole piece of land and then you get stuck with it? Or is it better to buy an option on that piece of land and then only risk $1,000? And then if I'm wrong, I'm wrong. I lost all of it, but at least I didn't lose everything, right? So with that analogy, call options, put options, call options give you the right to buy the underlying asset at a certain price at a certain time, which is strike and expiration. And then put option gives you the right to sell that stock at a certain time, gives you the right, not the obligation, to sell an underlying asset at a certain time at a certain price. Okay, pretty simple, right? Now, there is two types of options, American and European. You guys will figure that out. It's about how you exercise those, but let's not get into those details yet. Here's expiration date. Expiration date is when that option expires. It's just the name of it, expiration date, right? Expiration is, could be a week out. It could be a month out. In today's proliferated option markets, there are weekly options. There are bi-weekly options. There are bi-monthly options. But then the rule of thumb is if you're buying options in the old days, before the weekly showed up, options expired on the third Friday of every single month, period. But now you can do weekly because all the option jockeys are out there. They gamble. Oh, like let's say last week, Facebook earnings were horrible, right? You could have bought a 1 month out option, 2 month out put option, or a call option. If you bought call options, you lost your money. If you bought a put option, you made a fortune, right? And that's how I grew my little Robinhood account last week with buying Facebook puts. But now there is options like this Friday. There's going to be a bunch of options that are expiring, weekly options. Well, is it gambling? It really is. Yeah. So, but I will talk more about this in the future. What options I use, what I look for. Look, options actually is more complicated than technical analysis. It takes years and years to figure out. But again, I'm going to keep it simple. Again, you guys have to do homework on your own. And then expiration date, I explained. Strike price is the price of the underlying asset that the contract is being made. Okay. So let's take an example of Tesla. So Tesla, before the earnings came out, okay, if I bought a call option on Tesla, call options on equities specifically are sometimes every $2.50, sometimes every $5, sometimes every $10. So I will show you guys. I will share you guys my screen with the Tesla option chain, and you guys will understand what I'm talking about. But that's the contract price that we're setting. Remember the land? I told the owner I want to buy this land in 2 months or 6 months from you at this price. That is called the strike price. Now, the reason options are volatile or can make you fortunes or lose your fortunes is one single option, equals 100 shares of the underlying equity. Now, if I were to buy 100 shares of Tesla at $150, that would cost you $15,000. But I could have bought one single option that represents 100 shares of Tesla, let's say going out to June 21st, which is the third Friday of June. I probably would have paid $15, $18 for it. Times 100, I would have paid $1,800 for that option, for that expiration date, and for that strike price. Now, which one is more? $15,000, buy the stock, straight up or buy the option. Now, with the stock, the holding period is forever. You can hold Tesla for the next 25 years because you own the equity. With an option, not only you have to be right in the direction, but also on the duration. Because if I bought a June option, it's going to expire on the third Friday. If the stock is not above 150, which was our strike price, then I'm going to lose all my money. Meaning, which is the next one, it's called a premium. That's what I paid to that landowner to lock up that land, right? And that's what it's called a premium. So these 6 words, okay? 1, call option. 2, put option. 3, expiration date. 4, strike price. 5, contract size. Contract size is always the same. 1 option equals 100 shares of the underlying equity. And the premium. Premium is what you're paying to play. And so that's about options. I will definitely go deeper into this. There is something called the Greeks in options, but we're not going to go into that today. Those are delta, gamma, theta, rho. There's all these things that you guys will learn. But long story short, here is the books that I'm going to recommend you guys that you go buy. 3 books. Okay. The first one, Options Trading Simplified for Beginners. Again, these are books I have read, so I'm recommending it. I'm not affiliated with Amazon. I'm not affiliated with any of these people. But because I've read the books, okay, it makes sense to recommend those books because you guys need to do some homework or legwork. I'm just not going to feed you everything, right? That's one book. Again, it's on Amazon. You guys can go buy it. The second one, this is a little bit more advanced, but I know in the audience, I'm sure there's going to be some advanced folks, some intermediate folks, and some complete beginners. So for beginners, I would recommend this one right here. Or for intermediate to advanced, I would highly recommend this book because it goes into massive, different strategies. And this is like a hybrid between the two, okay? It tells you, it not only explains options, but it also gives you tactics, strategies, all these things. And, so take your pick. I mean, if your budget is $10, $20, whatever, pick the one that's $10, $20.